Hello, folks. A lot of people have joined in. Hi, Akash. Hi, Ashwini. Hi, Dhanush. Hi, Mehak. Hi, Rashika. Nice to see you again. Hi, Vaishali. Hi, Vineet. Thanks for joining in, guys. Hi, hello, Anand. Guys, we'll begin in about 4 to 5 minutes, just waiting for others to join in. So, to those who've joined us right now, we are live streaming today's session on LinkedIn as well. So please feel free to go ahead and tell your friends, share them about today's event, and ask them to join via LinkedIn if they have not registered in prior uh, for this event today. And we would love to see you guys, sort of spread a word about it. So please go ahead, do that. Also, a very happy new year to all of you. I think this is our first session after the beginning of the new year, and like we all usually have, you know uh, things to talk about related to new year resolutions whenever there's a new year. Of course, today's session is a lot around setting benchmarks for the new year and achieving new things. I would not specifically say it's a resolution, but I think all of us should definitely go back to what Sandeep had taught us last year and recall about how we can grow our savings. So today's session is again going to be really special, and lucky to have Sandeep back with us. All right. Cool. I think we'll start. Sandeep, good to go?
Sure. Yeah, absolutely.
Amazing, amazing. All right, very good evening to everyone who's joined in at Onsurity Wellness Wednesdays. This is Abhishek, your host, and it's an amazing feeling to see all of you back in this new year. And today's session is again very important for all of us. And we're stepping into a new year, sort of beginning to make new goals, work on new things, having fresh mindset about a lot of things. And it's the best time for us to sort of work on things that we left off in the last year and pick it up from where we left off, right? So that's where we are introducing our session today, which is about saving your investments and growing them, whatever you've saved. So just to take a quick recap on what we learned from our previous session with Sandeep, from investment, was that how you can sort of be mindful about your savings, ensure that you do not fall under a debt trap, ensure that you are not splurging your money into expenses that are not relevant for you. Thinking about your future is very important, right? And a lot of things about investing smartly while you are earning, right? Like an employee or a freelancer or a gig worker or a professional or a business person, right? So today's session is again a continuation to what we learned previously. And we have Sandeep Rao, our investment researcher from Investment. And it's an absolute honor to have you, Sandeep. And today's session is going to be very insightful for all of us because we're going to be understanding how we can, sort of save and grow whatever we've done in the past years. And it's ideally the best time for every investor to think about investing fresh because it's new year. And a lot of new things that will be also introduced in the coming forthcoming budget, which is almost a less than a few weeks from now that we're going to have the new budget.
True.
Very important for everyone in India to have their eyeballs on what's there for taxation, how can people save their money, and at the same time find better avenues to grow, right? So thank you so much, Sandeep, for picking up this topic and enlightening us today on understanding financial well-being, growing what you have saved. Part two of what we did in 2022. And to everyone who's joined us and are watching today on Zoom or from LinkedIn, I have a very quick note for you guys about Sandeep. So, Sandeep has 20 years of experience in understanding and interpreting financial markets. His experience in quantitative trading strategies, investments, data science, Content analysis has really helped him achieve a lot in his financial domain, and he also holds expertise in developing systematic investment strategies, believes in a quantitative way of living. And the best thing about Sandeep, which I always say, is that he's very eager in learning, and he's also very eager in teaching and making finance a simpler aspect for people to hold on to, right? So thank you so much, Sandeep, for taking out the time and making this topic simple and easy for us to consume. And happy New Year again, once to you and to everyone who's joined us. Over to you, Sandeep.
Thank you, Abhishek. Thanks for that lovely intro. And so let's, without much ado, let's get started. Okay. So today's session is going to be about growing what you've saved. And we're going to talk about a few things which I have shared over here on the screen. How much can we really grow our money? Can capital markets give us exposure to all sorts of asset classes? What is it that you may want to do starting this year? How to restructure your finances, and a bit about systematic investing methods. So we're going to talk about all that. So let's just jump in. Okay, so this is a part two of the financial well-being series being hosted by Onsurity and Investment. So in the first part, what we did was we spoke about just one second. So in the first part, what we did was we spoke about the first two pillars, without which what we are going to talk about may not make sense. That was about earning and saving. And as Abhishek said, it was about how to be mindful of your savings, and what also some science behind during what phase of your career you should be even more cautious of saving, making sure that you're putting something aside for your future. So those are the things which we spoke about, and that's available on YouTube. So you may want to look at that. So with that, let's jump in. Today we're going to talk about investing with a specific focus on investing in capital markets. Okay, so we all talk about growing the money, growing investing, all those things, but what exactly growing even means? So that's a question which I would want to start with. Okay, so if you grow your money by 10% every year, is it worth it? If you grow your money by 5% every year, like you would do in an FD, is that worth it? So what does growing mean? So that's a question which we would want to ask. Okay, and when you ask that question, the first concept that becomes relevant at this point of time is the concept of inflation. Okay, what happens to the value of money over period of time? Okay, and as most of you would be aware, inflation tends to, for whatever reason it happens, okay, it is a truth that we all have to live with. But what it does is it reduces the purchasing power of money. Let me give you an example. Okay, so I still remember, based on my memory, way back in 90s. I'm sure most of you would not have been born at that time. The cost of 1 liter of petrol was around 12 rupees. So you could just go to any gas station, pay 12 rupees, you get 1 liter of petrol. Now there's a typo here. It's not 2002 but 2022. That 1 liter of petrol costs around 102 rupees. So which is, if you, so for some reason, let's say you had some 12 rupees lying with you in 1992, and you had a memory loss in between, and you wake up 30 years later. So the person at the gas station or the petrol bunk is not going to even let you smell petrol because it's so expensive now. Okay, and why does that happen? That happens because of inflation. It doesn't happen only to certain commodities, but it happens to everything. But this was just an example that we do. Okay, now let's dig a bit deeper into this idea. Okay, so I gave you the example of petrol. So let's assume you are in 1992, okay, and you have 12 rupees with you, okay, and you go into some sort of an hibernation for 30 years and you wake up, okay, and you had 12 rupees, so you had four choices that time. Let's assume. Okay, so you could put that 12 rupees aside, in your favorite book, and forget about it. So the value of that 12 rupees, I don't know what it would be, but much lesser. Okay. Or with that 12 rupees, if you had put that 12 rupees in, let's say, a PPF, okay, public provident fund, you would have with you around 185 rupees. You could easily buy petrol today and save 85 rupees on top of it, 83 rupees on top of it, and you would still be good. Okay. Now, let's say you chose gold. So you could actually go and you could have bought gold at that point of time. And even that would keep you in good stead, because by now, when you wake up 30 years later, you have around 102, 100 rupees on top of, what you would need for 1 liter petrol. And if you had put your money in Sensex, you would be up around 365. You would be, that 12 rupees would be at 365 rupees. And that would leave you with a lot of money to do anything that you want, because, you have almost like a 3x surplus on top of what you would spend on petrol. The idea that I want to share over here is the value of currency, the ability what you can buy with a given amount of cash reduces, and that's one of the primary reasons we have to find out ways in which we could invest and grow our money at a rate which is at least equivalent to that of inflation. So in other words, if inflation is at a rate of around 6%, your money should grow at least at 6%. Otherwise, you are losing money. And that's what happens when you keep your money in, let's say, a plain Jane savings bank account, or in an FD. So if you are not getting 6% returns, which you wouldn't get consistently over a long period of time, the value of your money is actually reducing. And that is the fundamental thing which we need to be aware of, because as our money grows, as our savings grow, the effect of inflation on that is going to be even bigger. So with that, let's jump into what is it that we can do to make sure that we beat inflation. So before we go into the different ways in which we could beat inflation, I would talk about this concept called real returns, which is nothing but investment returns minus inflation, and that's what tells us real returns. For example, if you consider, as I just shared, 6% as the rate of inflation, and you're going to get 10% returns on an asset, then your real returns are just 4%. Rest of it is just inflation driven returns. So that actually doesn't matter at all. So you'll always have to subtract inflation from the returns to figure out what is the real return. Okay. So let me give you an idea. Let me ask you something. Okay. So let's say in the year 2002, a good 20 years ago, okay, you had put in 10 lakh rupees in buying a house. Okay. And that house turns into 30 lakhs today. Okay. That is almost 3x in 20 years. Is that something which is, is that asset, which is real estate or house in this particular context, did it give us anything, did it give us real returns, or did it just match inflation? To answer the question, it just about matched inflation and it did not give any real returns. Okay, while the figures may look like 3x in 20 years, but when you really put it on a calculator and figure out, what were the returns, the compounded returns that you got year on year, all you got was something maybe around 6 or little under 6 for 10 lakhs to become 30 lakhs. So you didn't really actually get any real returns other than, but you did cover your inflation costs. So that's something which did happen. But did you make money over and above? Did you make any real returns? The answer is no. So with that, what are the products? How do we get real returns? A few things which you need to avoid. First of all, when we talk about real returns, fixed deposits are nothing but products where you keep your money and they give you an interest at the end of the day. Okay, end of the year, it could be biannually, whatever, but you get an interest on top. So typically, it would be a little under the inflation, the rate of inflation. Okay, so if inflation is at 6%, you typically would get around 4 or 5%. That's how you're going to get it. On an average, in the over the long period of time, including all sorts of costs, taxation, everything, FDs don't really beat inflation. They underperform inflation. So over long periods of time, your money would not grow at par with inflation. Okay, so PPF is a shade better, but still it would pretty much end up being similar to being at par, and then it'll cover more or less maybe. Okay, and the third bit is physical gold. Again, physical gold comes with a lot of costs included in it, because there's a handling cost, there is a making charge included in it, there is some wastage which goes into it. So if you consider all those things, there's a lot of wastage which happens in real terms and return terms with physical gold. So you generally avoid, especially when you have other better options, better investing products that would cover your inflation, than FDs, provident funds, physical gold, all of that. So what is it that, if you are aiming to cover your inflation, we're not even talking about any real return right now. All that is, your goal is to make sure that the value of the money stays what it is. It does not reduce. So one option is inflation index bonds. So this is a product which is created by the RBI, one of the safest bond products, where if you put your money in these bonds, whatever is the rate of inflation, that is the return that you would get. And these investing in these bonds, you can be pretty sure that your inflation costs would get covered somewhat, but you're not going to make any return over the inflation cost. That's also sure. So that is one. Real estate and REIT. So real estate is directly investing in real estate. We spoke about that last time, whether it really makes sense to rent or buy. And in this particular context, we obviously are talking about buying real estate, whether that covers you for inflation. The idea is it covers you for inflation largely, okay, but it may not give you excess returns over inflation. REITs are again very interesting products which are listed on the stock exchange, and these also give you real estate like returns, similar. But the beauty of this product is you can invest in smaller sizes. So if you want to invest in real estate and all that you have with you is 5,000 rupees or lesser, you may not be able to do that directly. No one is going to sell you a piece of land for 5,000. However, you can get exposure to real estate through these category of products called REITs, and that's one way to invest in real estate, which helps, which is way better than directly investing in real estate. And REITs are highly liquid, so you can always sell them whenever you want because they're listed on the exchange. Whereas a real estate, a house or something like that is not really liquid, so you can't really sell whenever you want. Nor is real estate divisible, which means you can't really sell a part of your drawing room because you need some extra cash, but you can part sell your REIT investments, and that gives you the advantage of both divisibility, liquidity, and investing in real estate. So that's one. Sovereign gold bonds are another product which are actually again an RBI product, a very safe product. This product is actually a gold bond and it's not really gold. So what that means is RBI issues a paper to you where it promises to kind of give you returns in sync with gold. Okay, and RBI has several reasons why they would want to do that, but in this case, it's one of the safest ways to invest and get the returns equivalent to that of gold at the same time. But there is a lock-in period here which you would need to be conscious of. But if you are looking at gold, sovereign gold bonds are a great product as far as covering inflation costs are concerned. Okay, so these are like the two things. So avoid things like FDs, PPF, and physical gold. If your goal is to kind of beat inflation, you're not even going to beat inflation. Very hard. It may have happened in the past, but currently it may not happen in future. Okay, and investing products that cover inflation, inflation index bonds, real estate, REITs, and so on. Now let's move to more interesting stuff. Okay, products that allow you to not just beat inflation, but not just cover the costs of inflation, but at the same time get you returns way above that. So, which means if the inflation is running at around 6%, you may be able to make 5 or 6% on top of that. So, which means you can aim at 11% annualized returns with indexing. So that's quite possible, which is not possible with any other asset class. Now, you may ask me, why is it that indexing the or investing in the equity markets the only way to beat inflation? Now, if you look at the kind of companies which are listed on the exchange, there are a lot of companies which benefit or don't get affected rather during inflationary times. What that means is, let's say something like HUL, which manufactures consumables or which manufactures FMCG goods. Now, whether inflation or not, you're going to buy soap, you're going to buy toothpaste. Those are the things which are must you would buy. Okay, so you may cut down on those dinners which you would do because things are expensive, but you would not cut down on essentials. And if, because there are a lot of companies which are into the business of essentials, it could be banking, it could be a lot of those. Okay, their value is not going to their as a company, their value is not going to get affected by inflation, and in good times anyways they would do well. Okay, and index as such is a product where companies which are doing better obviously keep getting into the index. So index has the self-selection mechanism where bad companies go out of the index and good companies get into the index. So by investing in the index, you by default investing in the best run companies in the country, and you get an exposure to all of that. So that's one of the fundamental reasons, not just in India, but many other places around the world. Equity markets are the only way for you to beat inflation and get returns way above the inflation. So that is one. So with that, I would now look at, within this whole umbrella of equity markets, there are two ways in which you could approach it. So one is the plain Jane index investing. What that means is you are looking at investing directly in ETFs, which is nothing but exchange traded funds. If you have a demat account and you open it, you would find things like Nifty Bs. So these are index ETFs. These are listed, and they would typically cost you around anywhere between 100 to 200 rupees a unit, and you can buy as many as you want, and they would mimic the returns of the index. So if the index goes up by 10% at the end of the year, you would get 10% returns on your Nifty Bs or any other Sensex product which is there. So it would match the returns of the index. So you could do that. You could also use direct mutual funds, which are direct mutual index funds, which you could use, and they are more cost efficient, and you would get similar returns like that of index. It's very easy. Following a systematic investing plan is also easy here, because at the end of every month you could set aside whatever money that you want to invest. Very easy, simple products, don't have to really apply your mind, and it works. Among all the options, these are some of the best options that you have. But there's one thing which you may want to understand. If you want to kind of do a better job with SIPs, look at investing in markets at the time when markets crash. Okay, so there is this popular saying, right? So when there's think of buying when there's blood on the street. So that's exactly what you should be doing, which means on days or in weeks when markets are doing terribly, everyone is talking about markets crashing. Those are the days, if you could buy more of these ETFs, index ETFs, you would get the same unit at a lesser cost because the markets have crashed. And in the long run, because markets continue to go up, they would fall. But in a matter of even something like a COVID crash did not last more than a month. So in a matter of few weeks or months, you would see markets going up, and your net cost of buying those units, the units of ETFs, index ETFs or index direct mutual fund units, would be much lesser than what it would have been following a traditional SIP route. So make sure that whenever markets crash, you add to your existing SIP, and that's one way of doing better, even better with index investing. So that is one piece, simple, easy to follow. But let's say you want to do something much more than that. You want to get a return way more than what index investing would offer. Uh, you would have to explore what is known as systematic direct stocks investing. So you would have to select stocks which are, you have to directly invest in stocks rather than investing through ETFs or indexes. Now, let me explain why there is a difference. Now, when it comes to indexes, you are typically investing across 50 stocks. And then you're hoping and praying that, net out of the 50 stocks, the majority would kind of do well. And if the majority does well, the value of the index would go up and you would make some. But what if there was a way of picking just the best? Okay, what if there was a way of picking only the high performers and avoiding the non-performers? So in investing, there are these methods of investing. These are direct methods. Okay, they're called systematic investing methods. And I'm going to talk about one such method today, which again, historically has been proven to not just beat the index returns. Obviously, it would also beat, the costs of inflation, which are there because it beats the index returns anyways. Okay. So there is this factor called momentum factor. What that means is um, there the fund managers or people who run momentum factor based on models, what they do is they scan through all the stocks which exist in the markets on, let's say, a monthly interval. So they'll go through all the stocks which are there and see which are the better performing stocks over a period of, let's say, a few months. Okay, so they'll say, so you get a ranking sort of a thing where you would get, okay, so stock one has done 100% in the past 3 months, the other stock would have done 60%, and so on. So then you have a whole ranking of stocks which have kind of gone up extremely, which have done extremely well in the past few months. Now, this particular method says that take top 20 of those stocks which have been doing extremely well in the past few months and invest your money in those stocks. So, start of the month, you take 20 stocks which are the best performing based on their past 3 month performance. Okay. And what you would do is you would put your money and divide it between these 20 stocks. So you do that. And then the next month, you again, and you forget about it for a month. Okay. So, and then you come back after a month, and then you look at, again, you run the algorithm. So by now, what would have happened is some of those stocks which were in the top 20 list may have gone off because in the past 1 month, they would have underperformed. Some of those stocks would have done better. So they would continue to be in the top 20. And some of them would have not done so well, but they would still continue to be in the top 20 because they have not moved much. So they would continue to be there. So what you would do at the end of the first month is you would sell the stocks which are not doing well, okay, and then go back to the index, the ranking which you created, and see if there are any new stocks which have come into the top 20. If some new stocks have come in, you would buy those stocks, okay, and now you have an updated list of 20 stocks. And you repeat this process month after month after month where you are buying only top performing stocks, stocks which have performed well in the past few months, and just continue to do that. So doing this historically tells us that you would, not just beat index, but you would, not just beat inflation, but you would beat the index as well. And this approach is also known as buy high, sell higher, because you wait for the stocks to kind of make an up move and you then buy them. And then as they keep going up, you continue to hold them. And the moment they start kind of losing their returns, you exit them. So you try to catch that sweet spot where the stock has started to go up and it continues to go up. At some point, somewhere on the top, you would kind of, if not at the top, once it starts kind of lagging a bit, you exit. So that's what is known as momentum factor, or that's one of the systematic ways of directly investing in stocks. Now, I would not recommend, discretionary investments. Very important to keep that also in mind. Discretionary investments in stocks can prove very risky, which means, a friend tells you that buy Zomato, or now you have a new IPO coming up called Mama Earth. Someone recommends something, and you build a random set of portfolios because of friends, uncles, all of that. Now, that kind of an investing has no data attached to it, and hence it's very hard to say whether investing in that particular manner you would be able to beat inflation. Forget about making any real returns. But these systematic ways of investing offer the benefit of simulation. What that means is we can go back and check historically, if we had followed these rules of buying high and selling higher, would we have made money? And that's how we are confident in saying that methods like these offer a far better, greater odds to you to beat inflation and index returns. So yeah. So with that, I'll move to the 2023 playbook, which I would, ask. I would, ask you to think about. Okay. So the first thing that you may want to do, if you have not done this already, is we spoke about this last time as well, and I'll repeat it here, is to fix your asset allocation, which means whatever money you have, you may have a couple of lakhs with you that you've saved, or lesser or more, doesn't matter. Okay, so 100 minus your age, let's say if you're 25 years old, that would be 75. So that's the percentage which you should be investing in equity. So if you have 1 lakh rupees and you're 25 years old, okay, make sure that 75,000 from that 1 lakh rupees goes into equity. And I shared with you there are two choices that you have if you want to beat inflation. You either go the indexing route, or you can follow systematic direct investing through factors such as momentum. So that's another possibility. So either of these ways, but the money that you invest should be 75% of all the savings that you have. That should go into equities. That is one. Okay. So once within the equity, then you can figure out whether you want to do 50% indexes or 50% something else like momentum factor. That's your choice. But you need to make sure that at least 75% of all your savings are going into inflation. And when you are doing this asset allocation, do keep in mind everything that you have in terms of all assets that you have. You may have assets, you may have some provident funds, you may have all those things. Everything is debt. So you should not skew towards debt at this age. Make sure you have a fair bit of equity allocation so that in future, whatever you save is you're able to beat inflation. So that's how I would want you to explore systematic investing directly in stocks. So that's something, if you have not done this year, you may want to explore that, because in the long run, that gives you far better returns than any other known approach to investing in the markets. So with that, I would, bring this session to an end. Okay, and some of these systematic investing methods are available on our app. Investment. You may want to explore that. Okay, and if you have any questions, I'm happy to bring that up, and I'll take it up.
Guys, would request you all to sort of put down any questions pertaining to that slide that you have for Sandeep on the Q&A or the chat section, please. Sandeep, could you go 2 slides back?
Sure. This one?
Yes. So I had a doubt if you could sort of re-explain the part regarding equity allocation.
Sure. Perfect. So let's say, you have 1 lakh rupees with you to invest.
Right.
Okay. And you also have some 20,000 rupees with you in, provident fund, which anyways, because you're working in a full-time job in a company, they would have, such investments would have been made. So in lakh you have in all you have around 1,20,000 with you. Okay. So now of that 1,20,000, 20,000 is in debt, which is a fixed income product. Okay. So what that means is around 16% or 17% is already in debt. So if you have to make a decision about where to put that balance, 1 lakh rupees, okay, so you can take 10% more and put it in a bond or a government bond or some sort of a debt fund, okay, but the balance 90 from that 1 lakh should go into indexes or equity markets, so that your net 75%, okay, you are in equity. So 90 divided by 120, so you have 75%, which should go into equity. So that's the math.
Got it. All right. We have a couple of questions that have flown in. I'll
Awesome.
read them to you.
Sure,
In
sure.
the meantime, I request all the LinkedIn participants to please drop in your questions in the comment, or you could also DM directly to Sandeep, or you could DM us at Onsurity's page and we will get back to you. We have Mayank asking any specific way to park your short term funds other than liquid funds?
Well, liquid funds are the best option that you have. Other than liquid funds, there are these overnight funds, but they're all the same. So they don't really. The whole purpose is, meant towards parking your money for very short duration. But then you'll have to define, whether short duration is like 1 or 2 days, 1 week, or you're looking at a few months. But even then, anything other than fixed income products, there's nothing else that would be safe for investing in these short time frames.
All right. We have Atif asking where should we park our emergency funds?
Good question. So emergency funds, as lame as it may sound, I would say, so long, if it's emergency, it has to be in your savings account. Okay. So whatever it is, but minimum cash you should maintain in your, that's the rule which I follow. Okay. You should not be trying to make money out of your emergency funds. So emergency funds are just that, emergency funds, and you should be able to, at any point of time, take your debit card, go to an ATM and get that cash out if you need it. So don't invest, don't even think about investing and making money out of your emergency funds.
Got it. It should be just like plain a reserve, a
Yeah,
reserve.
it's a reserve cash. That's what it's meant for.
We have Pallavi asking what are the best tax saving investments
Best tax saving investments. Now,
for 2023, say for 2023.
okay. So, well, there's nothing, that whole tax saving investing space is not something where much innovation happens. Okay. So whether it is 2023 or 2020, more or less, the same logic applies. So there's only, you have these ELSS mutual funds where you can invest, and everything that other things which go into, be it insurance related products and so on, which go into tax saving products. But other than that, there's nothing different that you may want to do because it's 23, because nothing else changes there in that space. So if I were you, I would typically go with some sort of an ELSS product, which is nothing but a mutual fund. At least you get exposure to the markets that way, and the benefit of tax saving.
Pallavi, I hope that answers your question. We have Nikhil asking, what about current equity market? Any frequent ups and downs? Uh, that is really worrisome for him, he says. What do you think is the situation of the current equity market, says Nikhil?
Well, I wish, Nikhil, I had an answer. Then I would have, it would make my life very easy. I would have probably either taken all my money out of the markets and gone on a vacation, or I would have, put all my money waiting for the market to make some new highs. Now, so in short, no one knows what's going to happen in future. Okay, the only thing someone like me who looks at data can talk about is, we've had markets closing in positive for 7 years continuously now. Okay, Now, we've never had a single negative year in the past 7 years, in other words. So, will this be the eighth year? Who knows? I do not know. Okay. But yeah, so that's my answer.
We have Radhika asking a very employer specific question. She says, suppose I'm working at a 16 lakh per annum right now. What are the ways
Mhm.
to save the tax? And am I able to save the whole tax on my salary or not?
Well, you can't really, Radhika, if you want to save all your taxes, that's not possible. There's only a part of the tax that you're paying that can be saved. But if you're looking at, saving more, paying less taxes, probably entrepreneur, you should look at becoming an entrepreneur in future. That gives you far more avenues to save taxes. But being a salaried employee, there's only so much that you can do.
Absolutely. That brings me to a very interesting question. I think recently I was reading
Sure,
about
Abhishek.
gig workers and freelancers who have multiple domestic and international payments coming in. How do you
Mhm.
like sort of as a freelancer, how would you suggest someone to save the best on taxes? And is there like a norm on the budget that has been launched or earlier in the government that has been put down where people
Mhm.
like freelancers can actually save money on taxes because they have like n number of multiple payments coming in from like
Actually, when it
very
comes to, I mean, I'm not a tax expert, but I'm just
right,
sharing based on my understanding
right,
is, you are either a employee or you could be an individual who who could be registered as a proprietor, or even otherwise freelancers need not always be registered as a proprietor. But so long as you're running your own business, you get the you're allowed to kind of claim a whole lot of expenses which you incur to run expenses. So freelancers that way have that ability. They can always have that option where all the money that they spend either to upskill them or travel, whatever costs are involved in making that money that they make through their skills, they can always expense it out and pay
right,
taxes on the balance. So that way I think they always better in that sense compared to, let's say, a full-time employee.
correct. We have an employee from App Inventive asking, is equity purchase good for someone who has not much knowledge about the ups and downs of stock markets?
Well, if you're new to the markets or don't understand the markets, I think the index investing is absolutely something which you should explore because you don't really have to think about it there. So if you're looking at an SIP, a plain Jane, plain vanilla SIP approach, just blindly, I would say, if there's an advice which I would give to myself if I was younger, that whatever you save, you could actually blindly put that money once or twice in a month into an index ETF, okay, and just forget about it. You can be assured that given the growth story of India, you are going to be in a very good place after a decade or two. So yes, so if you're new to investing or don't know anything about it, go with direct mutual funds, index mutual funds. I say that again, or index ETFs, and it's absolutely safe to invest, and the product is designed for people who don't understand about markets.
We have Raghavendra asking your POV on investments for crypto. Uh, Being someone who's investing in crypto, I think the 30% capital, 30% on capital gains is something very ridiculous that the government has laid down. So even
Yeah,
I'm very inquisitive to understand, like, what is your view on 2023 for the crypto market?
well, there's a reason, I guess, why the government of India has brought in a 30% tax on crypto, because you know it is a very speculative asset. Okay, it's highly volatile, and the government of India obviously wouldn't want people to take those exposures. It is not within the control as well.
Right.
Okay, so if it's a company in India, if it's an asset which has correlations with something in India, they can still do something about it. But tomorrow if there's a 50% crash, they can't save your money, and that's the reason they are being protective of your investment. So I'm quite happy about the way the government of India has gone about it. The other thing about crypto is, I don't think the world has still figured it out in terms of whether it is an asset which would really, is it, correlated to larger markets? Is it not correlated? Does it really cover for your inflation cost? We don't really know about it. It's a very new asset. We do not know why it goes up and why it goes down. All that we know is it's highly volatile. And that being the case, I personally stay away from it as of now. And even from a legal standpoint, and the return standpoint, given the whole regime, that the tax regime around it, it just doesn't make sense personally to me. So I wouldn't really add that as a part of an asset class, which as a Indian you may want to have. I mean, there are many more products which are way better than cryptos for you to invest.
Anurag asks, is it important to have a term insurance?
Absolutely important. Absolutely important. So that is your backup. Okay. So if there are people who are dependent on you, it becomes even more important. So that's something you should do. And as you keep growing, as your compensation keeps increasing, you may want to increase that by having multiple term insurance products. So that's something which you should have.
Anurag, you can go check out on Surety's blogs if you want to know and read more about term insurance and how you can benefit as an employee as well. We have Ketan asking, is it worth to invest in NPS account to save tax?
Yes, it is. So you can explore all of these government schemes which are available, which will help you save taxes. But please do remember, it's not just about tax savings, but it is all about asset allocation, which we spoke about. So if you have a total of 100 rupees invested anywhere, make sure that, out of that 100, around 100 minus your age. Okay. So whatever is the value that comes, that percentage should be in equities. So that is something which is a very simple rule. Make sure that you follow that. You can include NPS, you can include PPF, you can do all of that. Okay, but don't over allocate to debt, especially you're young. Invest more in equities. That would work in your favor in the long run.
We have Dhania asking, what would be the best investment plan to accumulate money systematically or monthly for your child's higher education, which is needed after 5 years?
Perfect. Now, while the government has plans for a girl child and all that, you can explore those. Okay, but if you're looking at any particular goal, it doesn't matter whether it is your child's education, or it could be for be it your child's marriage, or it could be any other goal that you may have to buy a car or something else, to go on a vacation. Actually, it doesn't matter. We spoke about this in our previous session as well. The goal doesn't matter, because at the end, your immediate goal is to make sure that whatever money that you have grows at the safest and the most optimal way. Okay, so by that, what it means is, you should not put your money in a risky asset. You should not put your money in any asset which does not beat the inflation. So these are two things which you would want. So the goal could be anything, doesn't matter. Okay, so long as you are keeping money aside specifically for a purpose, the rules of investing should not change. So irrespective of the goal. So the logic still remains the same. You may still want to continue investing in equities, but your net goal is, if you have more money, invest more money in equities, but your net goal is over the next 10, 15 years, you would use that money for your child's education. That's fine. But the approach to investing need not change. Yes, there's one thing which you may want to do. So let's say your goal is around 15 years ahead of time. Okay, so your child is going to be in college in 15 years from now. As you get closer to that timeline, so which is around 10 years, 11 years, 12 years, you may want to remove your money from equity allocation, move it to debt, so that the last few years, if there is any volatility, you don't really have to bother about it. But that's a decision which you would have to take as you get closer to your goal, not right now. But if keep at least as you get 30% closer. Let's say if it's a 10 years ahead of time, you have a goal. So seventh year, start thinking about what you want to do. But till that point of time, the approach to investing does not change. Hello.
Sorry, I was on mute.
No problem.
Where do you think would one want to invest between KVP or NSC? This is
Mm,
Anurag's question.
well, there's not much of a. I would still. These are investment products which are not going to give you significantly different returns. So within that, you can go with everything. And anyways, there's an upper cap. So in each of these, so
Right.
you will very soon, reach that cap, and then you will start looking at another product. So I wouldn't want to overanalyze with any of these products.
Right. Gaurav asks, lump sum or SIP, which is more recommended? Is there any market volatility we should consider?
Okay. So, good question, this one. Okay. So, lump sum, well, if you have the money, go ahead. In the long run, it, doesn't really make a difference. Okay. But in one context, specific context, it makes a difference. For example, if you were unlucky and you get in lump sum and market starts crashing from that day on, okay, and continues to do so for, let's say, a few months or so on, it will take some time for it to go back up, things like that. But if you're doing SIP, at that point of time, and if you were lucky to capture all the bad phases of markets and invest only in those bad phases, then your SIP will work. But that's asking for too much. You can't really do that. Typically, markets go up more often than they go down. So in the long run, actually speaking, data tells us it doesn't matter whether you do lump sum or SIP. It's a matter of convenience. So, but what would make a difference, if at all, is you selectively buy on days where markets crash considerably. If you can time that, if you have that kind of a time and resources with you, where market crashes 4 or 5% and you buy only in those times, then you can probably do better over the long run. But yeah.
Rahul asks, is it safe to invest in P2P platforms, which gives the return of
Mm,
about 9% per annum?
I wouldn't recommend them. No, they're not regulated in that sense, so I wouldn't really talk about it.
Got it.
No,
KK Sharma asks, can we withdraw money from NPS due to any reason? If yes, then what are the conditions?
I'm not sure. I'm not really the best person to answer that question.
In which coming IPO should we invest? Polymer, Go Digit, Bajaj Energy, Go Air,
Okay, this
Oyo,
is a
and
good one.
Pharma.
This is a good one. Okay, now other day, Abhishek, I was generally reading this tweet where this person said IPO is a process where people who know the most about the company,
Right.
okay, which means the initial investors and the founders, they are trying to sell their stake to the larger world,
Hmm.
okay, and the larger world is trying to fight to buy that stake. Okay, so think about it. So they know that there is great value in the company, but they're trying to sell it off.
Right.
Okay, and the larger world retail traders or investors, they have very less idea compared to the founders. Okay, they're
Right.
trying to buy them. So there's a mismatch over there. Okay, so this is one. The other problem with IPOs is, if you really look at, this is a study which we've done internally as well. Okay, so if you look at IPOs as such, they have all IPOs. So let's assume that you create a rule for yourself that I'll buy into every IPO possible. Okay, so the success rate with IPOs are like extremely, extremely low. Okay, so what that means is, more than 70% of IPOs are not going to give you positive returns, after listing. So they're not going to. Everything is going to fail largely. The odds are against you. The second bit is this. There's another thing which, if you are keen about IPO investing, you need to think about it. If at all if the IPO or the listing is very popular, you're not going to get any allocation, or you're going to get very limited allocation. If it's not popular, you're going to get proper allocation, and you don't want it, right? Because if it's not popular, you don't want that particular IPO. So, but in that scenario, if you apply, you'll get the allocation. So, as a data-driven investor, I typically wait for any stock to be listed on the exchanges and be listed for a couple of years. That would give you a good idea about how the retail investors, how the larger market perceives that particular, product, that company, their idea, their business, and then you get a far better value. So buying during IPO is not something which is kind of a shortcut to building generational wealth. It doesn't happen like that. But yeah, so I would personally wait for a year or two for the company to kind of prove itself in the open markets and in the public markets, and then take a decision about investing in a stock. So long answer to that question is, in general, no major advantage in fighting for that little allocation and fighting for that small return that you get, if at all there is a listing which is with some positive gains.
Right. We have someone asking, do systematic direct stocks have a tax saving angle?
No equity product at the moment in the country has any tax saving. Okay, so if you hold stocks for greater than 1 year, you would pay long-term capital gains. If you sell them within a year, then you would pay short-term capital gains. So that logic applies. Simple as that. Doesn't matter any equity product.
In addition to that, he also asks, could you recommend any book for learning about futures and option trading?
Well, I wouldn't recommend a book, but I would rather recommend something like Zerodha Varsity, which is a great resource for
Right.
beginners. And that could be a starting point because they're pretty well structured. And if that, you're through with that, then, for there are a lot of other, once that kind of creates a structure, and then I would pick up specific topics from Varsity and kind of Google them or read more about them on YouTube. But the structure is something which I like, which is there in Varsity.
It's good for a beginner to start off.
Absolutely.
Amazing. Can you suggest me to allocate percentage of savings in long term slash short term, as well as equity and emergency fund? This is Anurag again with his fourth question.
Okay. Now, emergency fund allocation is typically based on your monthly expenses. Okay. Now, that defines your emergency allocation. So that was the first thing which you said. So you may, if you're starting, then you may want to have a couple of months of your expenses saved in cash. Okay. So once you are able to save more, I would say increase that to 6 months, 1 year, and so on. So that's the kind of money that you should be there in your savings account. Okay, may not happen on day one, but over a period of time it should happen. So that is one. Okay, the other one was, Abhishek, if you could help me with the categories, and then I can talk.
Sorry. Yeah, he
Abhishek,
asked
yeah.
long term and short term for
So
equity
one is,
and emergency fund both.
yeah, emergency fund is done. Okay, so within equity you have long term and short term. Okay,
Hmm.
well, I would, any kind of an equity investment, whether it is a systematic investing in stocks or indexes through ETFs, the returns start showing up only after a year or two. So there's nothing, which, when it comes to investing, and that's the reason it's called investing, there's nothing that it would start showing results in a matter of few months. You may get lucky, but it'll get tapered off in a matter of 6 months. So any kind of an investing that you do, whether direct investing in stocks or through ETFs and indexes, wait for a year or two to, see some kind of returns. So in that sense, I would say, if you are doing both long term and short term, it should at least be 80-20. The short term, initially, if you are new to the market, should be all about learning. So you should be willing to lose that short term money, because short term is extremely hard. So that is where, if you're following a system, fine. But at the same time, be okay to kind of lose that money or part of that money, because short term uh, is more risky, and it will be more volatile. It's a great learning experience, though. I would say that, if when I was young, I would definitely engage in short term investing and trading, but a small part of my capital, not more than 20%.
Sandeep, in connection to our systematic direct stocks conversation, we
Yeah.
have Isha Kataria asking some that should she consider investing on this for less than a year, like say 6 months or so?
No, any kind of an investing has to be for at least a year. Under that, the stock markets could be, in a shorter duration, the stock markets could be volatile, and it's very hard to, get to a point where you have to invest through a cycle, and that takes around a year to play out.
All right. That brings us to the last question, which is probably very easy. We have Raghavendra asking if you could recommend a nice YouTube channel to learn about finance.
Well, YouTube channel to learn about finance. Okay, so off late I've been watching a lot of videos on by Learn app, which is a Bangalore-based app, and they have some interesting content on equities. So that is something which I like, and so yeah, that could be a starting point. They've covered it all, so they have a lot of interesting content there.
Superb. All right. Thank you so much. I think with that, we come to the end of the Q&A. And
Sure.
I have one last question for you
Mhm.
to end the session with. What's your take for 2023 on investing? Say one line. If I had to, conclude the entire session and come up with one insightful advice for all of us
Mhm.
today, that what should one
Mhm.
do or think about for 2023?
Perfect. So my advice would be, make sure that you have greater than 70% money invested in equity markets. If you don't want to do it in lump sum, feel free to kind of spread it across over the year, but make sure you're sufficiently invested, in equity markets all through the year. And I'm sure you would thank me in 24 and 25. So that's something,
Absolutely.
yeah, that's what I would want to say.
Superb. Thank you so much, Sandeep. That was a very nice session.
Likewise, Abhishek.
And I think we've almost crossed the number of questions we had from the previous session. I think we had some 11 questions last time. We've crossed
Yes,
20
we did.
questions this
Yeah,
time. So really
absolutely.
glad to see everyone, sharing their views, opinions, having so much of clarity after whatever you explained. And,
Correct.
this sort of helps us make things much more simpler in the long run, if we have to ever sort of build more or have you again come talk about anything
Absolutely.
else on finance, right? So I think the base is really very clear, and you've sort of built a very nice foundation for all of us to understand finance in an easy way. And thank you so much. Request everyone to please make a note of Sandeep. Please make sure that you sort of go reach out to your friends or your HRs in the organization. Talk to them about how you can collaborate with investment. If you guys want any sort of a well-being seminar on finance, you can definitely reach out to Sandeep or anyone from the team, and we would love to see you guys spread a word. If you like today's session, please go put a thumbs up or do a shout out on LinkedIn for us, and share your views on what you would expect us to talk about in the upcoming sessions. And thank you once again, Sandeep. It's been an honor.
Thank you, Abhishek. Thank you for coordinating. It was lovely interacting with you.
Yes, thank you.
Bye.